Hello scholars. In previous video we Hello scholars. In previous video we discussed about standard deviation. In today's video we are going to discuss few more parameters, and remember this all parameters to analyze mutual funds. We have divided into four different heading: basic information, okay, in which there is a category, asset allocation, tax rate, age, AUM, and then three important headings under which cost, which have expense ratio, exit load, turnover, and then risk stats means statistic, standard deviation, beta, r square, sharpage ratio, shortness ratio, alpha, information. Everything is mentioned on the value research online, but as of now you don't need to go into information ratio and sharpage ratio just to reduce your work, because sharpage ratio and shortness ratio gives the same information, so you don't have to go into that detail. We discussed calculation of sharpage ratio, shortness ratio, and standard deviation calculation in a previous video. Today we are going to discuss calculation of beta and correlation and alpha. These three we'll discuss today. So let's take this example where I took the data of last 3 years from September 2022 to 2025. This is one mutual fund, Parag Parikh Flexi Cap, for demonstration purpose. And I took the monthly value, that is NAV value, that is net asset value. And this is the price. And to compare, I took Nifty base. This is a exchange traded fund, passive fund. As I mentioned, we can compare actively managed funds with the FD or passive funds or peer group itself. So here you can see that we are comparing with the benchmark or the passive mutual fund. We have to find whether this actively managed fund is better than the passive or not. If it is not better, then it is open to go. There is no use of investing in actively managed fund. So these are the prices, closing prices of each month, Nifty Bees as well as Parag Parikh. Okay, so these are the monthly prices. First step in calculation is to calculate monthly return. That is next month divided by first month, next month minus first month divided by first month, multiply by 1, multiply by 100, and so on. So we calculated a monthly return here. Okay, so these are the monthly return. It is nothing but the change, month to month price change. This is a Parag Parikh monthly return. I gave you as a Y. Then Nifty Bees we label as a X. Okay, and these are the Nifty return. Nifty Bees, basically Nifty Bees. Okay, now next step is very easy. Let's say if I want to ask you to calculate the total return, CAGR return, from if someone invested in 2022, as of now it has become 92 rupees. Bhav has become 92. So how do you calculate the return? In case of CAGR, okay, in case of CAGR, write down how it is calculated. It is the ending value. Okay, we can call as A, that is amount, then the starting value, that is P, then bracket raised to power number of years, then 1, then multiply by 100. This is the formula to calculate CAGR. Normal calculation, normal return change is calculated. It's very simple. A minus P minus 1 into 100. That is what we calculated. This return as well. If you simplify this, this is nothing but the aim is second value. Okay, like this only. Okay, so this is single period calculation. But if you are doing the multiple years, then we have to do the annualization. This is the formula to calculate CAGR. So first I'll calculate the CAGR of Parag Parikh. Okay, this is the formula. This 1.3 is just to that take a power raised to 1 n by 3, because 3 years is there. Okay, let me check here. This is 1 by 3. This is 3 year. Okay, so 1 by 3. Now I'll take, this is the last value. First value 49 and last value 96. Okay, so first value, last value, bracket raised to power this minus 1 into 100. This is CAGR of Parag Parikh. Now we are taking the actual prices. Next step is to calculate standard deviation. We discussed yesterday standard deviation. We can directly calculate from the returns. This is standard deviation. And I'm taking FD return 6.5% as a risk-free return. Okay. So now next step, what I'll do is portfolio return minus risk-free return. So this 23 minus 6.5 will this. And if we divide this by the standard deviation, you get the Sharpe's ratio. So let me write here. We discussed last time as well. Sharpe's ratio is equal to portfolio return minus risk-free return, FD return, divided by standard deviation. Okay, you get the Sharpe's ratio. And we have these three values there. Okay, see this. We have portfolio return, that is R. This is a return. This is FD return. And this is a standard deviation. Okay, you just find it out by this and you get 1.9 is the Sharpe's ratio. If you want to calculate short-nose ratio, then we'll have to calculate the downside ratio, and that we usually use the short-nose. Here I already explained you, so I won't go into that detail. But this is how Sharpe's ratio is calculated, which we discussed in previous video. Now today I'm going to discuss the beta calculation. Now for beta, okay, up to here you know that there was only parak, there was no stock or no index or no other thing. But when you do the beta and correlation and even alpha, you need index. Okay, that means data of stock, or here in case of mutual fund, and index, both Y and X. So beta is calculated by the slope function. This is the slope function of the Excel. Okay. Now details will be complicated, but as of now, for just focus by beta is, if you have learned in the mathematics, we used to calculate y2 minus 1, y2 minus 1 and x2 minus 1 is equal to slope. And this is what beta is. What does it mean? It is the change in the mutual fund return to change in the index. Okay. Suppose index increase 1%. How much change is happening in the mutual fund portfolio? That is decided by the beta. Suppose beta is 1.2. What will happen? If index increase by 1%, mutual fund will go by, it will be 1.2%. Okay. If index increase by 10%, it will be increased by 12%. Okay. And so on. So that is the how much your mutual fund portfolio increase with the change in the index. That represent the beta. And you calculate by slope function. You can see this, in which let's calculate. So you don't have to do this. This is just for understanding purpose. So slope function known Y means mutual funds, comma, X means index, comma. You are getting beta of 0.06%. It means portfolio will move less than the index. Okay, because it has a debt component. If you remember, I'll show that debt component. That's the reason it is moving less. So this is how beta is calculated. Now next step is calculate the Nifty return as well. The way we calculated the way we calculated fund return, that similarly we can calculate Nifty return based on this data. Okay, starting price, ending price. So during that same period, Nifty return has Nifty base has given 15% return, and Parak gave 23% return. Okay. Now immediately we say, what about this? This is just a day-to-day fluctuation. Don't go into that detail. This is from starting to ending. Okay. So in 3-year period, fund gave more return than the Nifty. So then we can calculate here. This is return market and risk-free return. That means index return minus FD return. We want to calculate alpha. So let's understand what is alpha. Beta we calculated directly. I'll show how alpha calculation is done. It is called as Jensen alpha. Okay, in which portfolio return minus FD return. Okay, this is the first step. Then beta multiply by market return minus risk-free return. Okay, I will put this aside and explain here separately. Alpha is very important, and for mutual fund investor, you must know that alpha is equal to, you can write down as well. This is return of portfolio minus return of risk free. I'll raise F. Okay, these are return minus beta of portfolio minus return of index. I'll write M minus return of FD or risk free return. This is how alpha is calculated. What does it mean? So this is a portfolio. That means how much excess return given by the portfolio as compared to FD. Okay, let's take an example. Let's say portfolio gives 24%. We'll take that same example as well. FD is 6.5 and beta is 0.65, something like that. Index gives you 15% and again 6 point minus 6.5. This is how you, if you take, you will get the alpha. So write down this formula. How do you calculate here return of portfolio? From the first value and ending value. FD return, you take the FD return or bond return. Market return, we calculated from starting value, ending value. Beta, we calculated from the data of both. It is called a Jensen alpha. Sometimes people consider alpha means just purely this. Okay, so there is a lot of confusion amongst the market professionals as well. Some people will say just portfolio return minus benchmark return is equal to alpha. But the hardcore professional will talk about this is the Jensen alpha. So be aware, asks the person which definition of alpha he is using. Is it a simple definition of portfolio return minus benchmark return or Jensen alpha? Why there is confusion? I broke a lot of head and understood why it is so. The reason is if beta is 1, let's understand. So this will it's very interesting. Okay. So alpha is equal to return of portfolio minus return of FD. I'll write F minus beta multiply by return of market minus return of FD. If beta is 1, then what it will look like? Return of portfolio minus return of FD. So now this is, if it is 1, then we can take directly like this. And this will become return of portfolio because this minus minus will become plus. Okay. So this is a minus here. So what will happen? This and this will get cancelled. And what remains is the only portfolio return minus market return. And this is what sometimes people call as alpha. Okay. But real Jensen alpha is based on the beta. So I solve this confusion forever. Commonly, usually the people who don't understand finance talk about alpha means this. That is excess return as compared to benchmark. But this is the real calculation. If beta is 1, then automatically this Jensen alpha become 1. But if beta is not 1, then the common alpha people talk about Jensen alpha will be different. But be aware. Okay. How to calculate alpha there? Now here, that's what I did. Okay. First step, what I did is I calculated beta. Then I already calculated portfolio minus risk-free return. Then next step, this is what I calculated. This I calculated market return minus FD return. So this is the first step. Then second step, third step, fourth step. Okay, this bracket I completed. And then last step is this bracket, this portfolio minus risk free, then minus this entire thing, it gets alpha. Okay, alpha is 10.96. Okay, just check this value of Parag Parikh. That alpha and all the things, it is the stats. Okay, so see this, these are the values. Sharp is coming 1.7, alpha is coming 9.1. Okay, beta is 0.57. Okay, and how much we calculated? Say this. Now you may say why it is different, because their data, they might have taken little different data. I pulled from other sources, but you'll see the numbers and this value are never constant. It keep changing, but not too much. But you can see beta is around that level. Sharp is ratio, it was 1.7, here 1.9 is coming. Alpha there was 9.5 and here it says 10. So there is not much gross difference. Okay. So this is how we calculate alpha. You learn calculation of Sharpe's ratio, you learn calculation of beta, now you learn calculation of alpha. And now let's talk about correlation. Okay, now correlation is as such simple, but it's very important concept in the investing. So first is you need two data series. This is for mutual fund portfolio and index. So we use a correlation function, okay, in which we select y and x. It's like slope function only. Okay, data input of beta and correlation is same, but formula is different. Okay, here is a correlation, here is a slope. You see the correlation is 80.85. If you take square, you get the R square. Now the correlation importance is this. Correlation can be from -1 to +1. Okay, this will be always in this range. Beta can go -2 as well or +2 as well, but correlation is always between this -1, 0 or 1. Now most of the stocks have the correlation of 0.8, 0.9 because they move together. But gold moves in opposite direction than stock. And so that is called as negatively correlation. That means if stock is going down, gold goes up over the long period of time. So it has a negative correlation or less correlation. So correlation is very important in portfolio diversification. But here you just understand how it is calculated. It's very simple. You just take the function of correlation, take the inputs of portfolio and index. This is what you get correlation. Now, what is the interpretation of this? The R square. Now you can say that whatever the portfolio return is achieved, 76% is attributed to the index. Okay. See, stock prices are dependent upon three factors. One is index, that is general overall economy. We call this as X. Y is the sectoral, in which sector that company, and Z is because of company factors. So there are three factors in any stock price: Indian economy factors, sector factor, and company factor. For example, if it is HDFC Bank, Indian economy, bank sector, and itself, HDFC itself. So R square tells us which factor is playing game, or in which factor is playing in the prices. So here R square represent how much percentage is attributed to the index. That means whatever the return we get, 76% will be attributed to the index. Check R square. Where is the R square here? Okay, here it is not mentioned. Probably we will see in the, when we check the comparison, that time we will see R square. Okay, so I completed the risk stats. When we do analysis of portfolio, let's start analysis of some more portfolio. Maybe HDFC, large cap. Okay. So as soon as you open, go to the categories already there, then go to the portfolio. I'm changing the sequence here. Portfolio, you write down how much equity debt. See, this is the sequence. First category, then asset allocation. Asset allocation, decide tax rate, and then go to the other. Okay. So first step is to portfolio. Okay. So anyway, go to the mutual fund, select portfolio, and find out this three first, and then go to other. Okay. So this is equity category. Then go to the other to find out age of the mutual fund. expense ratio, AEM, turnover, exit load. So what things we find on this other information is, so write down on others basic details, age, expense ratio, asset, turnover, exit load. These are you can see just at the beginning how much minimum. These are self-explanatory information. Okay, but 1, 2, 3, 4, 5, this information is required for the basics and cost. Okay, then next step is to go to the risk. So portfolio the starting, then risk. When you click on the risk, you check, you get the standard deviation, short-range ratio, and beta. Sorry, alpha. Now beta I explained today so that I could explain the alpha. Every day we don't use beta. Okay, we use only three because information is one and same. It gives unnecessary confusion. So even information ratio we don't take it. So this you see this three in a risk stat. So where are we now? Okay, so here we need to have this low, 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 and then high, 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 high. Okay, so I covered from here to here. Okay, information ratio we don't take it because other information alpha and is enough. If you are curious, you can certainly read it because this is once in a lifetime. Sharpies we don't use it because it gives the same information. What we use these things. Okay, and start seeing different mutual funds. How to see? Let's go here and go to the downside homepage, and then I'll show where are the mutual. You check any, you can take any mutual fund just for starting your assessment. Okay, so suppose this is a flexi cap category, and these are the different types of mutual funds. You open any and start understanding. Okay, let's say this one, Axis portfolio. I'm keeping return in the separate video. Let me finish today other parameters. Okay, so Axis you focus fund. So now this is a focus fund. That means it is not based on the market capitalization, but the strategic. Okay, so then go to the portfolio, select, you can find equity debt. Okay, then go to the other, then find the R parameters of age, expense ratio, asset, exit load, turnover, and then go to the risk stat and find it out. This shortness ratio, alpha. Now here alpha is minus, shortness ratio is less than 1. That means this is not, this funds we are not going to select. Okay, so up to here you can do the analysis. Okay, so which points we covered? We covered portfolio, we covered other factors, we covered risk, and return I'll cover in a next video. Okay, so then you will be able to analyze mutual funds like professional only. Okay, thank you very much.